Hello and welcome to this special tax season edition of Money Matters TV. I'm your host, Doug Hepburn of Hepburn Financial Advisors, located in Phoenixville, Pennsylvania. We've been providing advanced strategies for successful business owners, executives, and high net worth families for over 20 years. I'd like to welcome my special guest today, Nick Yzzi of Canon Capital, which is not affiliated with Hepburn Financial Advisors or Cetera Advisors. Nick is a practicing CPA with over 20 years experience and formerly with the IRS. Nick, thanks for joining us today.
Thank you, Doug. I'm glad to be here.
You know, as I said in the intro, this is a special tax season edition. You've been with us, as a regular guest every tax season, which is great because you got a wealth of knowledge. This one seems a little bit different, though, because it looks like Congress is working on tax law changes to retroactively change 2022 and 2023. Is that right?
Yes, Doug. The House on January 31st passed H.R. 7024, which is called the Tax Relief for American Families and Workers Act of 2024. And unfortunately, that bill includes changes that would change the child tax credit to make it more favorable for families with children. It would change the long-awaited research and development amortization to go back to expensing. It would change bonus depreciation, which is scheduled to go from the historic 100% to 80% in 2023. Then it goes to 60, 40, and 20 in subsequent years. That would revert back to 100%. And all these are going to be retroactive to 2023. And then for businesses, there's an interest expense deduction that's currently limited to 30% of business income. That would be changed as well. So they passed that bill on January 31st. They had to wait for the Senate to get back from vacation or recess, whatever they call it. And they will bring that up in the next week or so. In the Senate. We don't know yet whether they will bring it up, whether they'll bring it up with modifications, or whether they'll bring it up and just pass it. But if they do, that's going to require retroactive changes back to 23 and in some instances back to 22. With respect to the child tax credit, which a lot of individuals with children would be interested in, those changes would be automatically adjusted by I have to file an amended return. But in the case of the other things like bonus depreciation and interest and expensing for R&D, they would require amended returns if you already filed a tax return. So, I mean, I think it's unfortunate, but it's been done 2 or 3 times now in the past 10 years where Congress doesn't quite take into consideration all the ramifications that this does to preparers and taxpayers, and even the software companies that have to change their software midstream. So if this does happen, most of the tax season is almost over, although a lot haven't filed yet. But it's just inconsiderate, but it is what it is, and we're sort of used to it at this point. But that could change, and that's something you just need to keep your eye on. And your accountant or your CPA, if you have one, would let you know as well.
Yeah, it seems like the more things change, the more they stay the same. I know I talk to a lot of practitioners who complain that they're not getting final 1099s until, mid to late March. And, tax season has just been compressed into a month. So it makes it difficult for practitioners to get returns done by April 15th. So tax season extends through October.
Yeah, you're exactly right. And that's the case with our firm. And it's unfortunate because we don't have enough time to do it. And sometimes people think, well, it's the accountants who are dragging their feet, when in fact it's the system itself and it's the way Congress operates. And interestingly, this House Bill H.R. 7024 was pretty much bipartisan. It had a 357 to 70 vote, which, as you know, in the current climate is sort of unusual for anything that happens in Washington.
Yeah, I didn't look at it to see how the CBO scores that, but we know things are going to change at the end of 2025 because it all reverts back to the 2017 laws, right?
Yes. Yeah, the Trump law, the Tax Cuts and Jobs Act, has another year and a half to go, or at least at the end of 25, I should say. So we'll see what happens then. That's going to depend on who wins the presidency. who wins the House and Senate and makes that control either a drastic change or little change. We don't know yet, but obviously it's going to become another political football after the elections.
Yeah. So regardless who gets elected, there's going to be a lot of sausage made in Washington.
Yes. Yeah. We don't know if it'll be sweet sausage or hot sausage, but
yeah,
probably
right.
hot.
Are there any other changes that individuals can expect for the 2023 taxes?
Other than what we just spoke about, not really. The tax laws, there were some changes in late 2022, the Inflation Reduction Act that instituted vehicle energy credits for home and business. But with respect to vehicles, they raised the credit for electric vehicles to $7,500 based upon the battery capacity. Now, effective 2023, you can buy a used electric vehicle from a dealer and get a $4,000 tax credit. So that's new as well. Also effective 23, eligible dealers will be able to pass on the credit that you're entitled to as part of the sale price instead of you having to wait to get your credit by filing a tax return in the subsequent year. So they're all good changes. The electric market has somewhat taken a dip, but plug-in hybrids have increased in viability, and they're also entitled to the electric credit, the EV credit. Hybrid vehicles that are not plug-ins are not entitled to it. So, but those credits are available in 23. And then as far as energy credits for energy efficient home improvement credits, if you put in insulation or exterior windows or skylights or other energy efficient appliances, you can get a 30% credit, and depending on what that expenditure is, would determine what your credit is for that year. So if it's insulation materials or a system, it's $600. For exterior doors, it's $250. These are tax credits. For windows, it's $600. And then for the upper level things like central air, natural gas, propane, or oil water heaters, furnaces, or hot water boilers, it's also a 30% credit up to $600. And then if you go even further, so all those categories of credits, you can actually get a credit of as high as $3,200 in 1 year. And then if you want to go beyond that, if you want to do some solar, wind, or geothermal improvements to those type of energy systems, you actually get a 30% credit with no limit. And if that exceeds your tax liability, you would get a carryover to the future. So if you spend theoretically $30,000 on a geothermal system that heats your home, you would get a $9,000 tax credit. So it's pretty significant as far as those credits are concerned.
It sounds like it. Unfortunately, I don't think my neighbors would want me putting a windmill up in the backyard. So
no, windmill.
That's not going to happen in my neighborhood.
Yeah. But there are solar things and wind things as well that would qualify. Yeah.
Right. All the above. Yeah. All the above. Well, it's interesting. We got a viewer question from Paul Liedman of Philadelphia who asked, will tax refunds be bigger in 2024?
Yeah, when he says that, I assume he means when he files his 23 return. And as we just indicated, if all things were equal, he has the same amount of income that he did and the same amount of deductions as 22. Will the refund be bigger or his tax liability be lower? Only for one reason, theoretically, Doug, and that would be the way the tax brackets are adjusted for inflation each year.
Right.
So, and I'll give you an illustration. For 20, let's take a married filing joint return. For 2022, the 12% bracket starts at $20,550. But with inflation for 23, that 12% bracket starts at $22,000. And then if you get to the higher brackets, at the highest at 37%, for 22, that 37% bracket started at $647,850. But for 2023, it starts at $693,750, which is $45,900 more at the lower bracket. So in that sense, if everything else was the same, his income is identical, he would have less tax to pay in 23 than he would in 22. And that's because there haven't been any other changes. But let's say he did invest in energy credits, EV credits, or he did some other things with respect to the Secure Act, and then possibly his liability would go down even further. But all things things being equal. And the tax rates are adjusted for inflation annually, because if they didn't, what would happen? Your effective tax liability would go up if they didn't adjust those brackets for inflation, which in the past they didn't, but now they do. They've done that for quite a while now.
That's good. That's good. Good news.
Yeah.
Well, if you've got a question that you'd like us to answer, here's how to send your questions to Money Matters TV.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our hosts and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
So, Nick, back to the IRS. In the last year when we had the Inflation Reduction Act being passed, there was a lot of controversy over the 87,000 IRS agents that were packed into that bill and the funding for the IRS. What's going on with that?
Well, first of all, the accusation, depending on which news media you listen to, about 87,000 IRS agents wasn't really accurate, because it was 87,000 employees. Then there was an insinuation that the 87,000 agents would be carrying guns. And I'll mention that in a minute. There are IRS employees who carry guns, but they're not the auditors.
And hopefully not the ones you see.
They're the criminal auditors. But what's happened is, number one, they've lost $20 billion of that funding already in subsequent actions by Congress. But that those funds are meant to improve their computer system, which really is lacking. It's for administrative employees, IT employees. It's revenue agents who are the auditors, revenue officers who are the collectors,
right? Criminal
investigators who deal with the criminal aspect of taxpayers who are doing a variety of things in a criminal sense. Right. So it was across the board. So it wasn't just IRS agents. And were they carrying guns? The Criminal Investigation Division, they're called CID or special agents. They do carry guns. And they carry guns because they're dealing with a criminal element. They do backup for the president when it comes into the city, let's say, and the Secret Service doesn't have the manpower to be able to handle all that.
Right.
So they do have responsibilities which would require carrying guns, depending on the clientele they're dealing with. So, but they have hired people. The taxpayer service is still not acceptable, but it's gotten better. If you're calling in and you can't get through, if you have an accountant, I'd recommend that you have your accountant deal with the IRS, number one, to begin with, because he would know better how to respond. But secondly, they have a special phone number that they use called the Practitioner Priority Service that they can get in quicker and get more resolution to your problem than you would on your own. If you have to call, I'd suggest you call early morning or later afternoon. That would increase your likelihood of getting into the IRS. Sometimes you just need to just call something called the Taxpayer Advocate, which is a separate unit from the IRS, sort of related to the IRS, but they're very effective in helping you to resolve a problem that the IRS has for some reason not been able to solve for you. The other problem is if you're sending correspondence to the IRS and you're waiting for a response back, that could take you 6 months, because they still have a tremendous backlog of correspondence. And a lot of that correspondence includes amended returns, many of which include the employee retention credit applications that businesses have put in. That was the whole, you can get a credit for $26,000 for every employee. And you sold that on TV. And that has become an area of a lot of misfortune. And in fact, if that law that we talked about, that HR 7004 passes, they're going to prematurely end the employee retention credit program. It's already in suspense. So they'll accept new applications. However, they're not processing them very quickly. They're dealing with the ones that they feel are fraudulently prepared.
So let's
So
pause there for a second, because I know you covered a lot of really good stuff. One is, work with a CPA, somebody who is familiar with the IRS and from the outside, and particularly ones who practice tax preparation and are used to calling the practitioner's hotline. But two, the taxpayer advocate, I think, is really an important recommendation. Just from my experience as being a former tax practitioner, being able to go to somebody in the service who knows the inner workings, knows the people personally, is able to shepherd something through the process. That's extremely important, particularly in complex cases, because the frontline workers, while they do a good job, they may not necessarily have the experience, if you will, to handle a complex case. So having taxpayer advocates very, very important in that regard. But I want to touch on something, because years ago, I mean, back during the pandemic and shortly thereafter, we heard stories about tractor trailers full of paper returns that hadn't been processed out in Ogden, Utah, among other places. Has the IRS been able to work through that backlog?
yes, they have. And it was true that there were tractor trailers filled with paper returns and correspondence. They have significantly reduced that backlog. However, even according to the IRS, it's not at an acceptable level. Like everyone in business, Doug, they're having a hard time finding people to hire as well.
Sure.
So even though they have the funding to be able to hire whatever the 87,000 employees, they're not able to find 87,000 employees quickly. And number two is that they have to train all these people, and the training process takes time. And now you have the complication of many employees who work at home. So they have to have systems set up to protect the security network and all the other things that all of us have to deal with. So things have not gotten easier since COVID. COVID has made the world much more complex. That's
no, I can imagine. And now we're hearing stories about the IRS using artificial intelligence to be able to do a lot of the work that the employees used to do, which I guess in some respects automation makes sense, particularly if you are having a difficult time finding people, much less qualified people. So you kind of have to rely on technology. So I can see that being an issue. So what happens when somebody makes like an innocent error on their return, or they have a late payment or failure to file, or some other issue that is not necessarily out of the ordinary, but it just happens.
Well, there are processes to be able to have penalties, what they call abated or removed. And they have something called a first-time abate procedure. It's an administrative relief that they grant. And you have to know to ask for it. And that's why having an account sometimes is best to deal with your tax problems. But if a taxpayer who didn't have an accountant would call, if they had a late filed return, if they paid a payment late, they may have filed a return, not paid the tax that was due with the return, or they may have even on the business side made late payments of payroll tax liabilities. The first time abate procedure would apply. And as long as you had a good compliance history and have not had a problem with compliance in the last few years, they will automatically abate those penalties, still charge interest, but will abate those penalties for you 100%. So that's something to keep in mind. It's called first time abate. And you can Google that. And there's a revenue manual reference, which you really don't need because the people on the phone know what that procedure is. And it's pretty automatic. They'll go back to your system. They'll put you on hold and they'll check to make sure that you don't have you don't have a compliance history of filing late. So if you have a decent compliance history and it's a one-time affair, one-time error on your part, then they will abate those penalties, and they could be significant at times.
Right. Now, one thing that most viewers need to understand is that even if they penalties are only assessed if there's an underpayment. Is that correct? I mean, if you
Correct. I
have
mean,
100% of your tax paid in, but you know, were out of the country or had something happen or your house burned down, you had a legitimate reason for not being able to file on time, you could still file your return and not be assessed penalties as
correct.
long as you don't owe anything.
As long as you don't owe money, that's the key.
Yeah.
Now, in the
Yeah.
case of, let's say, a partnership or an S corporation, which don't pay taxes,
Right.
if you file a late return, they will assess a penalty against each partner for every month that the return was filed late, and those penalties are somewhat significant. So
Ouch.
that's sort of an exception to the rule. But for individual returns, if there's no tax due, then you won't receive a penalty.
Right. Right. No, I can see that because, that's sort of like a cascading effect because they're flow through entities. If you don't get that flow
That's
through
right.
return done, everybody down the line ends up paying the piper for that.
Yes. Yes.
Now, one thing that we've seen a lot of over the past couple of years, and there's been some high profile cases on this, where, identity theft has been an issue, of course, in the news everywhere. You hear about people, and even through friends, hear about people having their identity stolen, their accounts locked down, all kinds of other stuff. But in particular, some people have made a cottage industry out of becoming tax preparers, filing false tax returns, and then getting the refund for those false tax returns. What is the IRS doing to kind of stop that, and how can taxpayers protect themselves?
Well, obviously, a good security system and on your network is the key. But sometimes, people are very creative. You have some of the largest companies who've been invaded by fraudulent scammers, and to think that it wouldn't happen to any one of us is sort of ridiculous to even think that way. So you try to do the best you can. There's certain guidelines that even practitioners have to comply with IRS regulations, but they have made a good effort in trying to reduce the number of fraudulent returns that were filed. But some of that is due to once you have a return that was fraudulently filed, and it's amazing because I've heard stories about the creative genius behind some of these people who get hold of your Social Security number and then file a fraudulent return, and they're not all just electronic refunds. Some of them are paper refunds where they'll know when the refund's coming in, and they have couriers that go around checking mailboxes and pulling the refunds out of people's mailboxes. So you have to protect yourself. But I think a good thing to do, and I'll recommend two different things, is if you have a concern there, and I think we all do, I would suggest that you get an identity protection PIN on a voluntary basis. If you have your identity stolen, you'll get a PIN from the IRS in order for you to even be able to file your return electronically. However, you can get an identity IP PIN voluntarily by just going to irs.gov/IPPIN, and you'll be able to set up an account where you can't file a return, or no one else can file a return on your behalf in a fraudulent sense without having this identity protection PIN that you
So it's really
each year.
So it's really a preemptive step to kind of eliminate the potential for somebody fraudulently filing a return on your behalf.
Yes,
that's
absolutely. So I would suggest
that's a great idea
to your audience that they look into a voluntary identity PIN from the IRS. Part two of that is in dealing with trying to get answers from the IRS. Oftentimes, you could get the answers on your own if you set up an online account with the IRS, and I think that would be beneficial to taxpayers as well. In order to be able to retrieve information online, you'd have to apply for this online account, and you'd have to prove your identity with a driver's license. It's called a system through ID.me. It starts with IRS. They transfer you to a security company that handles this for the IRS called ID.me, and then it would revert you back to the IRS. But if you had an online account, you can go in and you can secure information about your history, about payments that were made, about letters that were issued on your behalf. And it might help you and your accountant be able to resolve problems easier rather than trying to wait on a phone call and maybe get a courtesy hang up, as they would call it, because they're so busy. So I would suggest that taxpayers would also get an online account with IRS that would be able to speed up the activity that you won't need from the IRS and trying to get transcripts, whatever other information you might need.
No, that makes a lot of sense. That makes a lot of sense. Now, we only got a few minutes left, but I wanted to see you circle back on the employee retention credit, because I know there's been a lot of controversy around that. We had this credit that came out during COVID, and then a lot of people applied for it. They found there was some fraud in the system. A lot of people got caught, and now you've got promoters out there saying, "Oh, get your ERC. You haven't filed yet." And what's going on with that?
Yeah, well, as I had mentioned, that the IRS put a moratorium on processing any more applications until they were able to just review what they had, and they tried to sort out and pull out the ones that they would consider fraudulent. And when I say fraudulent, it would be not telling people what the real qualifications are for the credits, not advising taxpayers that if you get a credit, you have to file an amended return, to reduce wages on the return for which you've received the credit, and which situations actually made you eligible for the credit. So all they were doing was taking these numbers, preparing returns, charging high fees, and IRS saw these coming in with very large numbers and suspected there was a lot going on here that really shouldn't have been. So they're concentrating their efforts right now on those. They are doing examinations. They're going to prosecute people. They also came out with a program for taxpayers who they feel were victims of some of these scammers. And if you would return the funds that you feel maybe you weren't entitled to through the application of the employee retention credit, you can return 80% of that money, and IRS will ask no questions, will issue no penalties and no interest. They'll just accept the money and let bygones be bygones. So, however, and let's take a step back. There are companies who have not filed an employee retention credit application, amended 941X, who are legitimately entitled to it. So you can still apply, and you'll get into the queue. But if this one act passes, they estimate that if they terminate the program earlier than expected, that will pay for all those other changes to the child tax credit, the R&D expensing, and all the other things you mentioned earlier. So that might be an impetus for Senate to actually consider this, because it's going to be revenue neutral anyway.
That's good.
But technically, for the 2000, there was a statute that's coming up April 15th,
right,
of this year of 24, where part of those applications expire. But then the other applications don't expire for the other year until 2000. For 21 year, don't expire until April 15th of 2025. So it's still open. But if this other HR 74 would go to Senate and be passed in their form and signed by the president, then it's going to terminate the program. So if you do have a legitimate application and a right to these credits, then I suggest you do it as soon as possible.
Get it in now. Well, Nick, we appreciate all the good advice that you have. This has been a great program. Our next week's guest is Mike Trabert. Tune into our next episode of Money Matters TV, where your money matters.